Hi everyone! So in the previous video we analyzed the highly regulated market in China with China Mobile, and today we are staying in that broader theme of regulation, but this time in a very different industry, casinos in Macau. And more specifically, we are going to look at Galaxy Entertainment Group. Before getting into Galaxy itself, I think it makes sense to step back and look at the type of market this company operates in. Because when we talk about China, one of the first things that usually comes to mind is competition. In many industries, competition is extremely intense. We have already seen that in others' videos, whether it is food delivery, EVs, or other consumer businesses. Companies often fight very aggressively on price, market share, and scale. Macau casinos are different. This is one of the sectors where the market is heavily regulated, access is restricted, and the number of operators is limited. So from an investment point of view, the starting point is already very different from most Chinese industries. Macau is not a free entry casino market. When the sector was liberalized in 2002, the government granted only 3 original concessions, and Galaxy was one of them. Later, the market expanded to 6 operators through a system of sub-concessions. Then in 2022, Macau reset the framework and launched a new tender. Since January 2023, the market has operated under 6 full concessions: Galaxy, MGM, Sands through Venetian Macau, Melco, Wynn, and SGM. And Galaxy's current concession runs until December 2032. And you can see that in this chart. Over the last 10 years, the market shares of these 6 operators have been relatively stable overall. So of course, regulated doesn't mean no competition. But because the number of operators is limited, competition happens inside a much more stable market structure than in many other Chinese sectors. One important point before we continue. Even though Galaxy reports its financials in Hong Kong dollar, the charts in this video will be shown in RMB. Since most visitors come from mainland China, I think RMB gives a more relevant view of the business and makes some comparisons easier. So I will sometimes mention figures in Hong Kong dollars when I refer directly to the annual reports, but several charts will be presented in RMB for better context. So now that we understand how the market works, the next step is to look at Galaxy itself. The first thing to understand is that Galaxy is not just a casino operator. It is really an integrated resort company. Gaming is still at the center of the business through traditional table games and electronic gaming machines, but around that, Galaxy also offers a much broader experience. Luxury hotels, restaurants, shopping, leisure attractions, cinema, live entertainment, and convention space. At Galaxy Macau, for example, you have 7 hotels with about 4,750 rooms, more than 120 dining options, luxury retail, the Grand Resort Deck, a 10-screen cinema, the Galaxy Arena, and the Galaxy International Convention Center. And when you look at the revenue mix, you can also see how dominant the flagship asset is. In 2024, Galaxy Macau generated 34.5 billion Hong Kong dollar of revenue, which was about 79% of total group revenue. StarWorld Macau added 5.3 billion Hong Kong dollar, or around 12% of group revenue. Broadway Macau was much smaller, while the construction materials division contributed roughly 7% of total revenue. So the picture is quite simple. This is mainly a Macau gaming and resort business, and within that business, Galaxy Macau is clearly the core asset and the main earnings engine. Before looking at the numbers, it is also useful to understand who the customers are. On the customer side, the safest way to think about Galaxy is through Macau's visitor mix, because the company doesn't disclose a detailed origin split for its own guests. In 2024, Macau welcomed 34.9 million visitors, including about 70% from mainland China, around 21% from Hong Kong, and only about 7% international. So this is still very clearly a mainland land market, with Hong Kong as an important secondary source of traffic, while international tourism remains relatively small, even if it's growing. In terms of profile, the market looks more like a working-age adult customer base than an elderly one, with government planning material showing the largest visitor age group as 25 to 44 years old. And there is also an important downside here. We will see later that this regulated market comes with obligations, especially the obligation to invest heavily. But another key point to keep in mind is that Macau depends heavily on mainland China visitors, and those visitors generally need a travel permit together with a valid Macau endorsement. So in the end, customer flows do not depend only on consumer demand. They also depend partly on the willingness of the authorities to make access easier or not. And for me, that is probably the biggest negative point of the sector. Now let's move to the financials. At first sight, this chart is not very attractive, because over roughly 10 years, Galaxy has shown almost no real revenue growth. In 2024, group net revenue was 43.4 billion Hong Kong dollar, still below 52.8 billion Hong Kong dollar in 2016. But that weak top line needs some context. Even before COVID, Macau was already becoming a more difficult market. One reason was the decline of VIP gaming, meaning the very high-stakes business tied to wealthy customers and junket operators. Then came the real shock: COVID. In 2020, Macau visitor arrivals fell 85%, and Galaxy net revenue dropped 75% to 12.9 billion Hong Kong dollar. So the flat 10-year revenue profile is really the result of two things. First, a weaker VIP cycle before COVID, and second, a massive collapse in traffic during the pandemic. Since then, the business has been recovering. Revenue rebounded to 43.4 billion Hong Kong dollar in 2024, then rose again to 49.2 billion Hong Kong dollar in 2025, which means growth of 13% year-on-year. So the recovery is clearly continuing, even if the group is still not fully back to its old peak. Now, when we look at the business mix, I think that the most important chart is this one. What stands out here is that non-gaming revenue has taken a larger share over the last 10 years. And that matters because it shows Galaxy, and Macau more broadly, is trying to become more than just a gaming market. The goal is to build a broader tourism destination with hotels, retail, restaurants, shows, and entertainment. Part of that is Galaxy's own strategy, of course, but it is also clearly supported by the government. Galaxy has been preparing for this for years through Phase 3 and Phase 4 in Cotai. And those projects are not mainly about more casino space. They are much more about non-gaming amenities. And that is why this capex chart matters. You can see that investment stayed very heavy even in 2020 to 2022, which was exactly when Galaxy was going through the painful COVID period. So this non-gaming diversification is not just a growth idea from management, it is also something the government wants. And all of that shows up very clearly in the earnings profile. You can see that earnings were moving up into the pre-COVID period, then COVID completely broke that trend, with Galaxy falling into losses in 2020 and again in 2022. Since then, profitability has recovered, but in 2024, the group was still not back to the earnings power it had before COVID. For full year 2025, basic EPS was roughly 2.44 Hong Kong dollar, which means an increase of about 22% year on year. Now that we have gone through the business model and the operating history, the next step is to look at the balance sheet, cash generation, and valuation. What is interesting with Galaxy is that you are not just buying gaming earnings. You are also buying a large resort asset base in Macau, and that shows up in the steady rise in PP per share. Of course, this is book value, not market value. The assets are carried at historical costs, so this is not a live appraisal. And with Macau property prices under pressure, we should be careful not to overread it. But the main point still stands. There is real assets backing behind the business. The other thing that stands out is the balance sheet. Galaxy ended 2024 in a net cash position with high liquidity and limited debt. That gives the company a lot of resilience. You could argue that this is a bit conservative from a shareholder point of view, because excess cash earns low returns. Now on free cash flow, no real surprise here. This chart is broadly consistent with everything we discussed before. Free cash flow turned deeply negative during the COVID years because operating cash flow collapsed while Galaxy kept investing heavily. Then, free cash flow recovered as Macau reopened, but in 2024, it was still below the level the group was generating before COVID. As we saw in the financial structure charts, Galaxy has a very liquid balance sheet, but historically, its payout ratio has remained relatively conservative. That said, shareholder distribution clearly improved in 2025, with a total dividend of 1.2 Hong Kong dollar per share, which represents a dividend yield of approximately 3.4% at today's price. And unfortunately for the moment, share buybacks do not appear to be part of a capital return story. As you can see on this regression chart, Galaxy has delivered very strong share price appreciation over the long term. But as we discussed earlier, the group also faced major headwinds. First, the decline in VIP clients linked to anti-corruption measures, and then the COVID shock. And that helps explain why, even at today's price, of around 35.3 Hong Kong dollar, the stock is still below its pre-COVID levels. And if we use full year 2025 earnings, the stock is currently trading at roughly 14.5x PE. So when I put everything together, I think the conclusion is actually quite nuanced. At roughly 14.5 times 2025 earnings, Galaxy doesn't immediately look cheap if you only focus on the fact that revenue and earnings have not really grown over the last 10 years. And on that basis alone, you could say the stock looks a bit expensive for a business that has gone through such a long period without real compounding. But I also think that will be a bit too simplistic. Because as we saw throughout the video, this was not a normal decade. First, the Macau market was hit by the decline in VIP gaming after anti-corruption measures. Then came the COVID shock, which completely crushed visitor flows and profitability. So the weak 10-year profile is not just the result of a weak business, it is also the result of very heavy external headwinds. And I think there is another important point here. The Macau customer base is still mainly made up of mainland Chinese working-age adults, not retirees, with the biggest visitor group in official planning material being 25 to 44 years old. And that is exactly the kind of population that has been under pressure in recent years, with weak consumer confidence, a prolonged property downturn, and still elevated youth unemployment in China. So it is not very surprising that discretionary spending on activities like Macau gaming has also been under pressure. Now on the positive side, I think there are several things to like. First, Galaxy still owns a very strong asset base in a protected market. Second, the balance sheet is extremely solid with net cash and a lot of liquidity. Third, the tax burden in Macau has remained broadly stable, which is important in such a heavily regulated sector. And finally, I think one important positive point is that Chinese households still have a very large stock of savings. The World Bank notes that China's household saving rate remained very high, at 31.3% of disposable income in 2023, while Reuters reported households' deposits at around 160 trillion RMB in 2025. So if confidence eventually improves, the firepower is clearly there. So for me, this is really a high-risk, high-return situation. The risk is that you are buying the stock at around 14.5 times earnings, and that growth could still remain slow over the next decade. In that scenario, Galaxy may continue to have a rather modest growth profile, and the upside could be limited. But there is also a much more positive scenario. If the situation in China improves, and if confidence and consumption start to recover meaningfully, then Galaxy could benefit quite strongly from that rebound. And that is why I think the stock is interesting. If you want exposure to a recovery in Chinese consumption and confidence, Galaxy could be one of the more interesting high beta ways to play that recovery. So, at the current stock price, I do think it can make sense as a small position in a portfolio. Personally, I think something like 1 to 3% of a portfolio can be justified, precisely because the upside can be meaningful, but the risks are also clearly there. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.